Hey guys, just checking if everyone is able to hear me. Hey Desiree, nice to see you. Nice and early. Sorry, I'm late today, right? Right at 1 minute before the webinar, I realized that there's something wrong with the computer, as usual, right? So we had to restart the computer. But yeah, we're all here now. Hey Julio, nice to see you. Joanna Francois, right? Syed Hussein, nice to see you guys, right? Mark, nice to see you too. Just let me ensure that my audio, okay, correct, my webcam, everything's working fine. Cool, right? Nice to see you guys. Yeah, today's session, right? It says I have a slow internet connection. Okay, just checking. Are you guys able to see my see me and hear me clearly, including my webcam? The camera is slow, eh? Camera is slow. Just need to do a quick internet speed test. Hey, my internet should be pretty fast. Right? It's pretty darn fast. I'll be wondering why my webcam is slow. The upload speed is fast too. I have a feeling something to do with I have a feeling it's something to do with GoToWebinar's I think. Okay, quality is not good for the it's so weird, man. Yeah, suspecting that was the case. Just give me a second. I'm just seeing if there are any options I have. That's correct. Okay. What about my screen? Is my screen clear at least? If the webcam is not clear, is my screen clear? Screen is clear, yeah. Okay, so we'll keep it like that. If you can hear me well and you can see the screen, that's the most important thing. If it's the screen, if the webcam is blurred, as secondary. As long as you guys can see the screen, that is the most important. Okay. Yeah, but in today's session, right? It's going to be a simple session, but it's going to touch on some things which we left out a bit of in the initial trade management series, right? So in our trade management series, we actually did touch on the support optimal stop loss and take profit placement, which Annabelle will be covering today, right? But on top of that, she's going to tackle some topics which which go hand in hand with that, particularly to do with margin, leverage, right? Things that affect your trade, things that affect your trade, things that affect your the risk management, the less sexy part to it, like the risk management part, the risk management part to trades. So sorry, my again tongue tied these days. All right. So okay, yeah, Kanamba, I'm doing good. Thank you for asking. All right. So all right, let's begin today's session. All right, let's begin today's session. I'll give you my own take on the whole risk management part of it. Right, some of the things that I've observed in the space, right, and some of the things to kind of run away from, right, right after we reach the agendas. Okay, as usual, we need to cover the disclaimers. Remember, guys, that everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade. Okay, now introducing a host for today, right? You guys know me already, right? But the person who will be taking you through this webinar later will be Annabelle, right? So she is a trader with us here at Everest Fortune Group, right? So she, Everest Fortune Group, we are finalists for 2019, 2020, and 2021 for best FX and best equity research. Usually work with the major financial institutions, but now we have a special partnership with IC Markets for the better part of close to 2 years already, right? Where we bring you guys the good stuff, the juicy stuff, stuff that will take your trading to the next level. Okay, now the agenda for today, important things I want to talk about, important things where I do want to give a few comments about. Okay, let me give my pen here. We start off with what is risk management. Okay, we start with what is risk management. It's a often what's the word for it? It's something which has been neglected by a lot a lot of people, right? Because a lot of people just think about the concept of, you know, they focus so much on the other part of it, which is like, which is trade management, right? There's a big part of the focus is on trade management, entry, stop loss, take profit, right? But then an equally important part, which is often overlooked, is the concept of risk, right? How much you should allocate to a trade, right? And also the concept of what I'm going to use, the word I'm going to use is leverage. Joanna from Kwa, yes, I know it's a mystery to you. It's the leverage is a mystery to a lot of people. And today we'll be really diving deep into margin leverage. Now we even have an MT4 open here. We're going to take a look into, you know, how leverage affects your trades, right? How leverage affects the relationship between leverage and margin, right? Is leverage, having a lot of leverage, is it really a good thing most of the time, right? And how does it affect your stop loss and take profit? Now, I mean, your your stop, not say stop loss and take profit, but how does leverage affect your losses and your profits, right? So we'll be taking a look at it in a bit. Okay. Yeah, I have my Super Dry sponsorship back, right? They have unofficially decided to unofficially sponsor me again. Okay, right? So yeah, some things I do want to touch on really quickly, even before I pass the time to Annabelle, is the concept of risk management. All right, so there are I was just sharing this with some of my team members, right? This popular thing called risk to reward. Okay, this popular thing to risk to reward. Now, I know you got a couple of guys over here, right? Can you guys let me know what you think is a good risk to reward, right? Can you guys let me know what you think is a good risk to reward? Is it 1:1, 1:2? Diana says depends on your account size. Fabio says 10:1. All right, 1:2, 1:2, 1:3, 1:1. More than one, do 3 to 4 preferable. Maybe you'll be okay. All right, I can see hardly anyone say 1:1. Now, why don't anyone use a risk reward 1:1? What's wrong with a risk reward of 1:1? All right, Joanna, I like your answer. Okay. Now let's go into another concept. Okay, I'm gonna give you two strategies. Okay, I got strategy A over here, and I got strategy B. Strategy A has a risk to reward of risking, for every $1 that you risk, right? You have $2. No, you have $5. Okay. Strategy B has a risk of 1. So 1. So every $1 risk, you get $1 take profit. So the majority of people say that strategy A is better. Okay. Now let's go one level deeper. Strategy A has a hit rate of 10%. So this is the win rate. Okay. Strategy A has a win rate of 10%. Strategy B has a win rate of 60%. Now, with this new considerations, which strategy is better, A or B? Right, I see a couple of you guys. Right, I like Marcel's answer. Right, I like Marcel's answer. Right, depends on our success rate. A lot of people now will say B. So initially, right, the idea was that you need a better risk reward, right? But then it's the same thing when it comes to, you know, a like trade management. You cannot look at one thing without looking at the other, right? You can't look at the risk reward without looking at the hit rate. Yes, you got to take more trades. Now I see some interesting points here, right? Is that hey Christian, I can see your chat, so don't worry about it. All right. So I see some interesting points here, right? Desiree is saying that you need to take more trades, right? Diana is saying is a little bit 1:1 is slightly riskier, right? Now, the concept of needing to take more trades is actually unfounded, all right? Meaning that it's not true, because we are talking about reaching profitability, all right? Out of 10 trades that I take, all right, out of 10 trades that I take, out of 10 trades that I take, right, I have I get 6 of them essentially will be profitable, right? These are out of 10 trades that I take, I got 1 that is profitable, right? In fact, with this risk to reward strategy A, you can argue that strategy A can take less, you're required less take less trades. But if you look at the risk reward 1:5 and a hit rate of 10%, this is actually a losing strategy, right? You got negative expectancy. This has positive expectancy, right? That means if you keep using strategy A, even though you have a very cool risk reward of 1:5, it looks pretty cool. Anyone asks you what's your strategy, what's the risk reward of a trade, you can say it's 1:5. But if you keep using this strategy, you're going to lose a lot of money. But on the other side, you have a less sexy 1:1 risk reward here. But because of your 60% hit rate, more often than not, you're making money. So it's not a case of needing to take more trades, because in this case, strategy A, you can take a lot of trades. You can take 1,000 trades and you still be unprofitable because of the negative expectancy. Okay. Yes, that's right. Fam, right? B is profitable, right? So if you need to know the concept of expectancy, negative and positive expectancy, right? And of course, the whole concept of risk management, risk reward. A lot of traders out there, right? A lot of traders out there, they like to show you that, oh, look at me, I took this what I call a Hollywood trade. I took a Hollywood trade 1:10, right? I risked $1, I made $10. I risked 10, I made $100. It looks great, right? But they're only showing you that one small snapshot of that trade. They don't show you the 9 trades that they took before that, which were not able to hit the 1:10. Okay, so it's always important to go to your risk to reward, right? Your risk to reward has to go hand in hand with your win rate. Okay, you can have a shitty risk to reward of 1:1, right? As most people say, is you must think about it, that's what the media kind of tells you, right? Go for the Hollywood trades, go for the 1:5, 1:10, right? The reasons why they want you to go for that is because it is usually a lot harder to make profits on a 1:10 risk reward. Why is that so, right? Why is that so, right? If you have a risk reward of something like 1:10, your stop loss, if this is your entry, this is your stop loss, and then your take profit is all the way up here. Okay, even as price kind of goes all the way up, there is this much of emotional kind of I would use the word turmoil, right? But emotional trade management that you need to take care of as price kind of goes up and down and up and down and up and down as it kind of finally tries to reach to take profit. Humans have this thing called fear of loss, right? So we usually never ever let I'm sure rather a lot of you can resonate with it, right? I'm sure a lot of you can resonate with it, but how many among you guys have closed off a trade before it hit its full take profit, right? Just, yep, I can see Joanna saying that too, right? Yes, right. You can see a lot of you guys, right? Yeah, that's what I'm saying. A lot of you guys close off your trades before you hit your full take profit. Now that is hard enough with a 1:1 or 1:2. Imagine a 1:5 or 1:10. The amount of emotional kind of strength and resilience you need to really hold your trade to the full take profit is incredible. And most of the time, we never ever allow it to do that, right? And then that affects the expectancy of our trade. So imagine if we are 1:10, right, risk reward, and we had a hit rate of 12%, right? Yes, we will be positive, right? But because it is theoretically, it is possible to hit 1:10, but realistically, most of the time, maybe you do only 1:2. Even if you hold it all the way, we hold it to like 1:7, right? And it looks pretty good already. 1:7 with a 12% hit rate would not be a profitable strategy. It'd be a negative expectancy strategy. All right, so you might have the best strategy, really good risk reward, no, as in really good, like 1:10 risk reward, but because you're not able to hold it to its full fruition, right, you end up, you know, the emotional resilience you need to hold it to its full fruition, right, you end up having a losing strategy, right? And the thing is, a lot of in some sense, my own little conspiracy theories kind of like take on it is that a lot of you know, a lot of people like to teach that, right? I mean, the people who, okay, maybe I'm not allowed to go into that whole conspiracy theories thing, but yeah, it's just trust me, right? It's not a bad thing to have a bad risk reward, like a 1:1 risk reward, right? It all depends on your hit rate. Now I'm going to touch on one last thing before I pass the time to Annabelle, right? And that is called your locus of control, right? Now, as I showed you over here, you know, I'm going to do one more thing. I'm just going to erase. Okay. Oh, sorry. I'm just going to do one more thing, right? But talking about locus of control, okay? And it's something which I touched on a bit in the past, which you might have heard about, right? So I always use the concept of a weather forecast, right? So if you have a weather forecast, right, one weather forecast is telling you it's going to rain, okay, it's going to rain. One weather forecast tells you that it's going to be raining in 1 day, no, in 1 hour, right? It's going to rain in the next 1 hour. Another weather forecast tells you it's going to rain in the next 1 week. Which weather forecast is more trustable, right? Which one will you trust more? 1 hour. Will you trust the 1 hour or the 1 week? Ajay, there's no two over there. It's either 1 hour or 1 week, right? Ajay says he trusts 1 week more because he's the weatherman. You know, he maybe you know how to do the rain dance. Yeah. Most of you guys say it's 1 hour, right? Because it is within your locus of control, right? You know that, all right, but barring an apocalypse or something, right? The next 1 hour is very likely, you know, it looks like it's going to rain, right? But next 1 week, so many things can happen within 1 week, right? That is the same concept when it comes to trading, right? If you have an entry over here, and your take profit, right? Let's just say your stop loss is over here, your take profit is over here, right? This small little movement, right, is within your control, within your locus of control. But if you have a risk reward of like 1:10 all the way up to here, right, 1:10 all the way up here, sure, it looks great, but there is so much more in between your entry and your take profit. There's so much more. Yeah, that's why you scalp, Christian. That's why I scalp too, because you know that when you get in, you know, nothing, you know, there's a lot less that can happen in this crazy amount of time that price might hit your take profit. Who knows, you know, Russia invades Ukraine, you know, it might be right on every single technical and fundamental level, by some news event comes in, right? Russia invades Ukraine, you know, or Russia decides to cut off the oil supply, right? You know, maybe you know, the queen passes away, right? How does it affect so many different things, right? You might be right on so many different fronts, but because of all these uncertainties from a fundamental point of view and also a technical point of view, you know, you could have a multiple swing highs over here that price needs to break past before you can even reach your take profit, right? There's so many things in between. Your locus of control is being weakened. Okay, so that's the concept of risk reward. If you have a tight 1:1, you know, you naturally have a tighter control or better control of your locus of control, right? And that helps you manage your risk better, you know. And yeah, it all ties back to risk management, risk to reward, right? Locus of control is a concept of risk that you also need to embrace, right? Yeah, Julia, especially today, so much stuff that can happen, right? And you might be right 90% of the way, right? You might be right on the first day, the second day, the third day, fourth day, fifth day, 6 days, 7 days, you're correct. On the 8th day, some news item comes out and, you know, price tanks, right? So the more you leave yourself exposed, the further the weather forecast, right, the lower the chance there is on you getting it exactly right. So that's why you need to think about it in this kind of perspective, right? Risk reward 1:1 is not necessarily a bad thing if it puts you more in control of your trade. Okay, I'm glad you found that as good advice, Joanna. All right. Now, I have eaten up a lot of time into Annabelle's presentation. I like to digress a bit because I love to tell you guys a lot about this stuff, right? I will pass the time on now to Annabelle, right? And she will take you through the rest of the webinar, right? Have fun asking her questions, especially to do with margin and leverage, right? It really help you. She'll show you the lot size calculations, how it's applied into real world kind of trading setting, right? You know, and all the questions that you have about it, feel free to ask her. All right. Now over to you, Annabelle.
Hi guys. Hello Dana. Hi. Nice to see you too, Dana. Okay, I shall continue with today's session. You guys can see and hear me clearly, right? Hi. Am I sharing the agenda screen right now? Clear. Okay, that's great. Okay. Okay, let's continue. So I will be covering some slides on what is risk management, when to increase and decrease your risk per trade, how is stop loss, lot size, and risk related, some topics, a topic on margin and leverage, the calculations to it, how it's a double-edged sword, and also lot size calculations, right? Hi Simon. Okay, thank you, Dinah. Okay. So what the front part will be slightly more dry because it's more fundamental, the basic understanding of what is risk management for those who do not know what it is. But the back part will be slightly more interactive and more numerical. So there are more demonstration, and I will show you guys some of the examples at a later part, right? So what is risk management? We do need risk management to protect our positions. So imagine if you have a trade that you are in and you do not have proper stop loss and take profit levels. So it endangers your take profit part. For example, if your entry is here and then your take profit is here, right? For example, and then without proper risk management, imagine there's no stop loss and price came crashing. If there's no stop loss, no proper risk management, your whole account might be wiped out. So for Forex wise, risk management comprises of some action that allows you to protect against the downside of a trade, right? We need to protect position. So number 2 will be managing levels of risk to maximize gain. So what I mean by this is the more risk means the higher chance of a sizable return, correct? Because high risk, high reward. But it also means that there's a greater chance of big losses. So later on, I'll be touching a part on leverage. So with a very high leverage account like 100, okay, or maybe 500, you will have a potential of maybe more sizable account, which people tend to, kind of overbuy or oversell, and then there's a potential upside, but there's also a potential downside, right? And then the last one, proper risk management also includes correct position sizing, setting stop loss, and controlling emotions. And how does a trader do this? Oops, sorry, let me erase this. And how does a trader do this? So risk management will include all these 3 points that I will talk about later on. And why is risk management, proper risk management important? So proper risk management helps you to trade more strategically, correct? So it helps you to identify, analyze, accept, or mitigate uncertainty. It's about identifying opportunities and acceptable levels of risk. So with proper use of your stop loss and take profit levels, it helps you to preserve and grow your portfolio and prevent it from being overblown. Okay, preventing emotional trading. So with this proper risk management, it gives you sort of like a discipline, correct? It set boundaries for yourself, not to trade with anger or impulse, which most of us do, right? We like to chase. Sometimes we like to chase the trade because we think it's always we are always correct. Okay. And lastly, it is important to also calculate your R to R ratio, because as Desmond mentioned, 1:1 is good, but sometimes if you can aim for 1:2 or 1:3, that would be better. So you need to calculate your risk to reward, which is also risk management. Okay, so how do you manage, and what are some of the fundamentals to risk management? So number one, you need to identify your appetite for risk. So working out your risk appetite is extremely important, because you need to know what is a comfortable risk, or what's a comfortable position size that you're willing to risk in one trade. Because if you do not know what you're comfortable with to lose in your trade, your position size might end up too high, resulting in a big loss that might affect your emotions or affect your next trade. Okay, it is also for the first part also, it is also important to know which currency pairs you are focusing on, because for some currency pairs they are more illiquid, meaning to say it's harder to enter and exit the positions. So please identify your risk appetite as well as which currency pairs you are trading. Okay, so position size, selecting the right position size is also important, or later on I'll cover on calculating your lot sizes if you do not know how to calculate. Okay, it is important as the right size will both protect your account and maximize gains, right? Position size is important. Okay, so it also includes knowing your stop loss and take profit levels, because your stop loss will determine how many pips, which also translate to what is your lot size, which also translates to how many percent of the account that you're willing to risk. Okay, these all work hand in hand. Okay, it's like the anatomy of a trade. Okay, so stop loss and take profits. Okay, this one I've touched before in a previous session on my stop loss and take profit webinar. So having a stop loss and take profit level sets some boundaries, as well as give you a discipline, right? Because if you have a fixed stop loss and take profit is good, but having a boundary set is good at preventing you from impulse trading. Okay, to avoid trading under stress, fear, or greed. Okay, remember to also calculate your R to R when entering a position. Okay, next we have leveraging. Leverage allows traders to gain more exposure than their original account might otherwise allow. So there is a higher potential to profit, but also higher risk. So you have to manage. And lastly, we have controlling emotions. Never let your emotions control your trades. So take your emotional out and trade objectively. So what I do, or what most of us do in average fortune group, is that we have a journal or a logbook to take down our trades, strategies, or what positions that we take, so that we can refine our strategies over time. Okay, so when to increase and decrease your risk per trade? Any idea? So how do you guys actually manage your position? Like, do you enter a position and just leave it there, or do you actually increase or decrease your position as the day move on? Is it common? Risk calculator, but do you increase your positions over time? Like, for example, if Euro USD today is on a bullish run, and then you have a open position a long position in Euro USD, would you actually increase your trade size or trade position, or would you leave your position as it is? Okay, I have some answer, increase and decrease. Okay, I would, but I feel, okay, most of us would actually leave the position as it is. But when should you increase and decrease your risk per trade? So this is I'm not sure if you guys have seen this, but my point to bring across, I have to reshare this. Okay, so for risk allocation wise, what would be an ideal trade per ideal percentage trade that you are willing to risk per trade? Yeah, commonly is 1 to 3. Okay, there are some people who are willing to risk less than 0.5 or maybe even more than 10. Okay, depending on what's your risk appetite. Some people might say account sizes, so it really varies. Okay, so my question to you guys is, if let's say Desmond were to give you $1,000 FOC, okay, to bet on the roulette table where there is 18 black and 18 red, 1 green, how much would you bet on this roulette table for black to win? Would you give your 100%, because this is free money anyway, all in 1 to 3%, 10%, 50%? What is the risk that you are willing to take? Diana says 1. 1 seems to be a common answer, but it's free money. None. Oh my god, that's a good answer. You should pocket the money. Okay, anyway, what if I change the scenario to this? If there's 32 black, 1 green, and 4 red, and for black to win, would you change your answer to 100%? Yeah, commonly people will say all in or 50%, right? Because your odds of having black to win is very high. So most of the time, given it is similar to FX. So the point to bring across here is that if your setup ticks all the way, your fit levels, your fit confluence, your stochastic, your RSI, your moving average, maybe your divergence, even everything lines up clearly, right? And all your currency pairs that are in correlation lines up properly. If your setup is so good, your risk allocation will be naturally higher, right? Because the odds of you getting it correct is higher, unless there are some news that's out, but that's an outlier, right? That's a black swan, so we don't consider that. But given a normal daily situation, if your setup is that great, naturally your risk allocation will be higher. News count and your seller is done, yeah, correct. So the point here is that good setup means increase in your risk allocation. Okay, so how is stop loss, lot size, and risk related? Okay, risk allocation as well. So this is how you actually how they are all interconnected, like I mentioned before. Okay, so account size of $50,000 in this NZ currency pair that we are trading is NZD USD. So this is the percentages. So these are the percentages based on a 50,000 USD account. Okay, based on a 50 pip stop loss, a 0.1 lot is $50 and 1 lot is $500. So how much you are how much you risk affects the lot size you trade. Correct? So you need to know exactly how much your risk appetite is, like I've mentioned. What's your risk appetite? Are you risking 5%? For those who do not know how to calculate your lot sizes, later I'll have an example. Okay, so give me some time. So number one, you need to understand what is your risk appetite. Okay, how many percent are you willing to risk? Okay, then you also need to know where your stop loss. You need to set your stop loss, right? Because it's proper risk management. Where is your stop loss? Okay, then we calculate the lot size. So this is how it's sort of interconnected, right? You need all this. So this is actually risk management. Okay, it's a very broad term, but it's a broad and simple topic, but yet there are so many small details inside that you have to take note of. Okay. Okay, so given this situation, scenario A and scenario B. Okay, scenario A, 50 pip stop loss and 90 pip take profit versus 20 pip stop loss and 36 pip profit. Which one do I make more? Can any of you guess? This one looks like it's making more, right? 90 pip take profit versus a 36 pip take profit. Any answers, A or B? 50 pip stop loss, 90 pip take profit versus a 20 pip stop loss and a 36 take profit. Okay, I have some answers. B, I make a lot but too much emotions. Yes, indeed. Okay, we have some answers. Okay, yes. Okay, so for Desiree and Simon, yes, both are the same. Okay, because you take, oops, my handwriting, sorry. 50 pip stop loss, 90 pip take profit versus 20 and 36. They are the same. Yes, it's the same. Okay, it doesn't mean that the longer the green stick, the bullish stick, or the take profit candle, the more you make. It doesn't work this way. Okay, this is the basic calculation of your risk to reward. Okay, so 50 over 90 versus 20 over 36. So they are the same if you calculate. So what my point is here, it's not about how many pips you make. Okay, it's not the pips that you make. So it doesn't mean that 90 pips is a lot. It's about your R to R, right? Your risk to reward. Okay. Okay, margin and leverage. For those who are new to margin and leverage, it's quite a simple topic that I'll run through with you. Okay, so leverage, what is leverage? So for example, if you are given a $10, if you are given you give $10 to a broker, okay, and then the leverage on that account is probably, they give you a 10 times leverage. Means that if you produce a $10 to the broker, they allow you to trade up to $100. Okay, leverage means how much you can enhance your original amount to. So if you deposit a $10, a 10 time leverage means times 10 of it means $100. If you put in $100, 10 times leverage means you can put in you will get a $1,000 account. So essentially you are sort of borrowing from the broker. Okay, borrowing, loaning money to invest. Okay, usually you borrow from the brokers. Okay, so many brokers require a percentage of trade to be held in cash as collateral. So technically that is your margin. So for example, wait, let me see whether the next slide. Okay, I will explain what's margin in the next slide. But leverage means that you borrow money from the broker, to essentially blow up your account, right? You don't need so much cash layout. So if you want to trade, because typically a normal lot size is 100,000. Okay, so for example, if you want to trade a normal standard lot size, you might not have such a cash outlay. So many brokerages, they actually allow maybe 100 times or even 500 times leverage, so that your cash outlay is lesser. So if it's 100 times, you only need to deposit $1,000 to get a 100,000 account. Okay, so that's what leverage means. Okay, so technically you trade larger positions in any currency, but it also means that you get stocked up faster than a normal 1-to-1 ratio. I will show you guys later on. So it's a double-edged sword, meaning it also magnifies your losses. So required margin is only $200 because your leverage is 50. So margin and leverage sort of come hand in hand, right? Because for example, your required margin is $200 with a leverage of 50. Okay, why they give you this? Let me calculate. 1 second. Okay, so usually your margin and your, yes, correct. So your notional value is 10,000 divided by 50, give you 200. So your required outlay is only 200. Okay, I'll give you examples here. What if you do not use leverage? You can, some people, they prefer not to use leverage, but if you want to trade maybe like your stocks or your shares, some of them have a standard contract size which requires bigger ticket size, meaning you can't trade on a micro, or you can't trade a micro contract. You have to trade a standard contract, which is a big ticket, typically 100,000. If you are translating this into cash outlay, means you need to take up 100,000 in cash, which for most people is not affordable. That's why leverage comes in, because if a brokerage gives you 100 times leverage, you only have to deposit $1,000. So if you do not want to use leverage, is perfectly fine as well. But for some contract sizes or some currency stocks, shares, indices or indexes, they require standard lot size, a standard contract size. So people will prefer to use leverage. Yeah, and using leverage is also a high risk, high reward, you know, because you can trade more in that sense. Potentially you have more, you have a bigger hand or a bigger pot to play with. Okay, so what is margin? So for example, if you see on a page that they give you a margin of 50:1, it means 2%. So how do we actually get that? What I do is I take one, usually is 100, divide by 50, so you get 2%. Okay, 100 to 1, 100 divided by 100, 100 divided by 200, 100 divided by 400. Okay, so this is in percentage how much is required of a total amount that you want to deposit. Okay, this is what they mean by margin, and how they portray in ratio versus how they portray in percentage. Usually what you will see is this. Okay, so different brokerages require different margin, and also depends on what's the leverage that is allowed. So for example, this is a leverage example. Okay, for those who are not familiar with leverage, if I have a 1 to 20, it literally means you have 20 times. 1 to 100, it means you can blow your account up to, you can increase your amount times 100 times. So if you deposit a 10,000 times 500, it gives you 5 million. So essentially you can trade up to $5 million in total. depending on what's the contract size, whether it's a standard, a micro or nano, or depending on what contract you are using. Okay, so right here, okay, what we are trying to portray here is that leverage is a double-edged sword. Okay, so imagine if you put 10,000 in okay, 5 lot versus 1 lot, yeah. So this is a higher risk because you play 5 times, right? This is essentially 5 times of this. So this is 5 lots versus a 1 lot. Your capital is the same, but if you make a 100 pip profit, essentially right here on a 5 lots, you will make $5,000. Okay, because on a standard lot, which is 100,000, 1 pip gives you $10. Because this is the standard. So if I'm having 5 lots, means 500,000 means $50, right, per pip. And then if I have made 100 pips, it means times 100 more. Okay, so remember, for those who do not know, one standard contract equals to 100,000 units, which also equates to 1 pip move on currency. Yeah, these are all on FX. 1 pip equates to a $10 move. 1 pip move equals to $10. Okay, this is standard. Okay, so on a high risk 5 lots contract, I actually make $5,000. Okay, if it's a 100 pip move. And on a normal, let's say if I do not have leverage, I only have this X amount of money, so I only can trade 1 lot, right? I only make $1,000, right? This is 50%, right? Versus a 10%, right? High risk, high reward. Okay, but this is because you have leverage to bump you up. Let's see, why is it a double-edged sword? Because we always look at the positive side of things, but then if you look at the losses that you might incur, right? Technically, in the same scenario, you could also potentially lose $5,000 on a 5 lot trade, as well as a smaller loss on a 1 lot trade. So leverage is a good thing, but you have to manage it properly. Okay. Okay, maybe I show you an example first. Okay. Let me try. Okay, the example that I want to show you guys is about the lot size trading. Okay, for example, do I have money? Okay, give me 1 second. Okay, for example, now I play, maybe let's say I buy a 0.1 lot. Wait, 1 second. Why can't I buy? Okay, 0.1 lot. Okay, let's say if I buy now, this is 0. Looks like it's going up. Okay, I buy. Okay, so I bought here. Versus if I buy, let's try again. A 0.01 lot versus a 0.1 lot. Okay, let's see. Mm-hmm. 1 second. Profit. 1.09. Wait. Oh, this is. Let me key in. Hang on. Stop loss. let's try. Okay, never mind. What kind of modify this? What's the difference? Now I want to show you guys the difference. Okay, wait. Let me change really the take profit 02. This is which lot? One. Oh, okay. Let me try 02. Give me 1 second. I need to modify this. Why can I modify this? One second, sorry. Give me one moment. Oh, right. Got it. Okay, 02. Let's try again. I can't. Why can't I do this? Okay, what my point is, I wanted to show you guys that if you have a bigger lot size, right, your take profit and stop loss will be much nearer. So given a bigger lot size, it's faster for your account to be blown up faster than if it's a one-to-one normal lot size or non-leverage. Okay, so leverage account gives you the potential to go for bigger trades, which also equates to a bigger loss, right? Okay, anyway, we'll have some examples. Let's just come to the example of the calculation of a lot size. Maybe this will explain faster or explain better. Okay, so for the example here, so the parameters, if you deposit a 3,000 USD into account with a leverage of 1 to 100 and a risk of 5% per trade, stop loss of 50 pips. Does anyone of you know how to calculate your lot size here? What is the lot size that you have to key in? Does anyone know? Okay, so for a deposit of 3,000, if I have a leverage of 100 times, it gives me 300,000, correct? So this is the total amount that I can trade with, even though I have only $3,000. So if let's say, okay, for Euro USD, okay, so if Euro USD is at 1.25 and I were to trade on a standard lot, okay, let me calculate. The 300,000, if I were to do a standard lot, which is 1.25 times 100,000, right? 3, 4, 5 means I can have 2.4 lots, if 2.4 standard lots, if I were to trade a normal standard size, given that Euro USD is 1.25 and my account has $300,000. Okay, but with this example, I'm only willing to risk a 5%. So let's just ignore this. But I'm just showing you the calculation of a lot size. Okay, this would be a normal standard lot if we are trading standard lots. But this example says that we can only risk 5%, which is $150. Yeah, $150. So this person is only willing to risk $150. And given that there is a stop loss of 50 pips, my entry is here, stop loss. stop loss is here, 50 pips, right? Per pip, I can only lose $3. So you remember me saying that a normal lot size, if I move 1 pip, equals $10, right? So for a normal pip in a standard calculation, if I move 1 pip down or up, it means a $10 move. Okay, so $3 means times 1 pip. So this is how we calculate the lot size. Is it complicated? Okay, so for this is quite mathematical, but for certain trading platform, you have to calculate your own lot sizes. So this is the breakdown of how you calculate. Firstly, you need to know how much you are going to risk, and you need to know what is your stop loss levels. Okay, for those who do not want to go through such a headache, you can actually go to certain websites. Let me try to find, like maybe baby pips lot size. If let's say you do not want to go through the hassle of calculating, you can actually go to maybe baby pips, or you can just Google any lot size calculator. No, not this, position size. Yeah. So account balance, we used back the same example, right? So account balance, what can I get? Oh, sorry. Let's say I have, wait, how much do I have? Let's say I'm willing to raise 5%, 50 pips. Okay, no, this is 3. Yeah. So standard lot size of 0.3. Okay, if you do not want to go through, the hassle of calculation, this is how you go by. Okay, I'll run through one more time quickly for those who are unsure. So based on how much you are depositing, you can calculate what is the total size of your amount you have in the account, because the brokerage gives you 100 times leverage, right? So 3,000 times 100, you have 300,000 in your brokerage account now, okay, because you are using leverage that they give you. So out of this 300,000, if you are only so this person, he is only willing to lose 5% of his original amount, which is 3,000. Okay, so he is only willing to risk $150 based on what he has outlay. So 5% of this gives you $150 with a 50 pip stop loss. Okay, 50 pip stop loss, $150 risk. So 150 divided by the number of pips means $3 per pip move. Okay, the max price for 1 pip is actually $3 since stop loss is at 50. Okay, so if the move is $3 per pip, it means that I am looking at a 0.3 lot size, because a standard lot size of $100,000 units, 1 pip move is $10. So I take 3 divided by 10. Okay, so this is the lot size that I'm looking at. So how to calculate your lot size? Number one, you need to know how much you are risking, exactly like the amount, or at least a percentage. And then you need to know where is your stop loss, how far away is your stop loss. Okay, and you also need to know whether you are trading on a standard lot size, or a micro lot size. Okay, I hope this is clearer. If you still do not know how to calculate, you can use the lot size calculator, or there are some page, or there are some articles where you can find examples of how to calculate the lot size. Okay. Okay, I have come to the end of the session. Let me see. Okay, sorry. Last part. Key takeaway. So in today's session on risk management, the key takeaway or what I want to leave you guys with is these few points that I have concluded, which is you need to work out the attitude to risk. You need to think about your risk to reward, your position size, and percentage of account balance for each trade. Okay, you need to place stop loss to protect against the market. So this is risk management, right? So you need to place proper take profit and stop losses. Okay, and be wary of leverage. Leverage is double-edged sword. So you need to be sure. It doesn't mean that if the brokerage gives you 1,000 leverage, you have to use it. So just be wary. Okay, you need to know your position size, your lot sizes. Okay, control of emotions. Don't chase or don't impulse trade, and keep a journal to make your to write down your journey on trading so you can refine your strategies later on. Okay. I deposited in SGD. How to manage the lot size since my account is in SGD. You can calculate it based on SGD wise. It's the same calculation. Yeah, it's the same calculation. The method is the same. Okay, it's just different currency pairs. Okay, so I've come to the end of my session today. I hope you guys have learned as much as I did from Desmond. So thank you, and we will see you guys soon again. Thank you for tuning in. See you guys next session.